When it comes to investing, have you ever wondered whether or not you should keep doing it yourself? And if not, when is the right time to find an investment manager? Well, stay tuned to this week's episode of the Retirement Income Source, where it's all about the income. Welcome to Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host Sarah Samuels. And today we're going to talk about do-it-yourself investors. When it's okay to do it yourself, maybe when it's not okay. And, when should you actually be considering bringing somebody on, depending upon who you are and your current stage of life.
Well, Dave, it's great to be with you, of course, and with all of our listeners out there. And this is really an important topic, I think, because a lot of people get this idea about do-it-yourself, right? We have all of these TV shows talking about flipping a house. They make it seem so easy, right? A lot of people get this idea it's a lot easier than it looks. And that can be reinforced if someone has some success with doing those do-it-yourself investments while they're growing their accounts and they don't make that transition to working with an income specialist, that type of financial advisor once they're nearing the retirement years.
And to some degree, you have to. When you're starting off, you have to do it yourself. You have to know a little bit because in many cases, when you start off, you don't have enough money to really pay a financial advisor, right?
There's always a fee associated typically.
That's right. If there's a fee, that's a percentage of your assets. You don't have a lot of assets, there's not much fee. And then you have to go to a non-fiduciary. Somebody's going to charge you a commission. And even then, if you're not investing a lot, the commission's not that big. So you're really going to get the best advisors at that point. Yeah. So I find that a lot of people, Sarah, start off and then they eventually, for many reasons, gravitate toward having a financial advisor. Now, it doesn't always happen, right? Sometimes people are smart enough and they like doing it. They make it their life hobby, if they will. Some people play golf and tennis. Some people like investing money, and they're good at it, and that's okay. But then there's some people like the recent Robinhood craze, right, where everybody gets involved in Robinhood. And
the FOMO, right? Fear of missing out. Nobody wants to miss out on it.
They're buying all kinds of stocks that didn't make a lot of sense, but they seem to be going up. And some of those people got lucky and did well. And frankly, that's dangerous because then they're always thinking about, oh, I'm good at this. I'm better than I really am. And I'll tell you, as a pilot, one of the most dangerous pilots is a pilot that thinks he's better than he really is.
Absolutely, right? An overconfident pilot. Hey, I can make that mountain. That's right. I can go over it. I'm not going to brush up against it.
That may not end well. That's exactly correct. But the other side of it is a lot of those folks took a good shellacking. They lost a lot of money when some of those stocks dropped. And as a result, they've said, you know what, I'm not going to do that anymore. And it scared them away maybe in a healthy way. Now, some of those might continue it doing themselves. They might use mutual funds. They might do it more conservatively. Others decide even at a young age to go out and work with advisors. But again, not for everyone, but for most people at some stage. So the question is if and when.
Yep. Well, let's talk about who or when it might be the right time to be a DIY investor, because our next question comes from Brandon in Mississippi, and it might be the right time from Brandon. We'll see what Dave says. But Brandon says, I'm in my 30s. Most of my money is in my 401k. I'm really interested in DIYing my investments because I don't have a lot saved at this point. What do you recommend?
All right, Brandon. Well, first of all, again, at your age, it's more common, and it's common because it's hard for advisors to actually manage your 401k funds. They have to charge you a separate fee, so you have to be willing to write a check, whereas most money managers just take it out of the funds, and most of the time that's not available to you in a 401k, so that's a challenge. You kind of get stuck doing it yourself, but what you want to do at that stage is to do well, and if you screw up, it's okay, but not too badly. So the best thing is really diversification. Be diversified. At your age in your 30s, as long as you have the risk tolerance for it, you should probably be 100% in the stock market. And I won't say exactly set it and forget it, but create an allocation, walk away, and don't look at it every day. It's just going to make you crazy. Because when you're saving at your stage of life, you dollar cost average. You're buying more shares when the market's down, fewer shares when the market's up. So the dips actually help you. So how do you do that? Well, it's important to go to the different stock funds that are in there and look and see. You might have some large company funds. They're called large cap for capitalization. You might have some smaller company funds, small cap for small capitalization. You might have some international. And you probably want to do some some large cap, some small cap, and some international. Probably with more toward large, just so that you're not being overly aggressive. But give yourself a good mix, a good diversification. Then the next thing is go get reports. There's a lot of places you can get free reports that give you information, that rank the funds. So look at some of the long-term histories. Don't just look short-term. If you're looking at a thing that just did well over the last year, guess what? You could be buying high and it might be ready for a drop. So look at long-term histories, and do they have a good, solid long-term history? And if they do, fine. So pick the best funds in each category, maybe 2 in each of the 3 categories. Go ahead and buy, and then only make minor adjustments and rebalances as market conditions allow. So I hope that helps.
Yep. Brandon, thank you so much for sending in your Ask Dave question. And if any of our listeners have a question that you would like to ask Dave, maybe you'll hear your question answered on a future show. All you have to do is send us an email to askdave@retirementincomesource.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today we're talking about DIY investing, do-it-yourself investing. Now, a lot of people might think that there's a misconception here that it's always easy to do DIY investing. But Dave, I think you put that to rest when you just mentioned how much research Brandon, our last Ask Dave question, how much research he would really have to put into making sure that he's doing a good job with the DIY.
Yeah, it doesn't take a lot at that stage when you're all stock. I mean, in theory, you can buy a Standard & Poor's 500 fund, which is the Fortune 500 companies, mostly large cap, and buy it and just ride it out. It could be as simple as that. Now, for Brandon, I got a little fancier. I said you could put a little bit of small cap in there, a little international, and that might help. There might be times when one zigs and the other zags, so you're not stressed out about losses. But it doesn't even have to be that complicated. You can just use an index fund if it's available in a 401k. And then you don't have to research it. You're investing in the index.
Right. Well, you mentioned diversification. That's probably one of the most important things that a DIY investor at that stage, like Brandon, should be looking for, right? To diversify within the stock market.
Well, and keep in mind, even the S&P 500 index fund is still diversified amongst 500 different large company stocks here in the U.S. So it's still a good diversified fund. I just want to give him a little bit more diversification. Where a little international, a little small cap. So now, like I said, if you're going to that level of diversification, this is where you might want to go out and take a look at Morningstar, for example, Morningstar reports, where they rank them on a 1 to 5 star basis. And you don't necessarily want to buy all 5-star funds because, as there's a book in the 80s, Sarah, called In Search of Excellence by Peters and Waterman. And it basically says that everything eventually mean reverts. Things that are above average revert to the average. Things that are below average revert to the average. So think about it like if you're kneading dough, right? You start at the edges and you push it to the middle. You start at the edges, you push it to the middle. That's what happens. So you don't want to go with all, 5-star funds, but you also, 3 or 4-star funds are okay. So if somebody wants to diversify, like I suggested there, then it's easy. Then you can go ahead and diversify. But you want to look at those. Still get some of those Morningstar reports or other reports to find out about the funds. And again, look at the long-term histories, not just the short-term.
And then you want to set it and forget it, right? Let it grow. Don't make yourself too crazy looking at that, your money going up and down each day.
And there's some things like at the beginning of a stock market recovery cycle, the large company stocks take off first. So maybe you want to move a little bit more toward the large company. You get in the later stages of the cycle, the small company stocks start to take off. International stocks, they're based often upon the dollar and what the Fed does with interest rates. And right now there's some concern about that with the Fed lowering rates and what that all means. So coming up, we'll be talking a lot more about how to manage it as a do-it-yourself investor, even at later stages in life, if you're in that transition period or in the income period. And then also when perhaps you should no longer consider doing it yourself. I'm David Scranton here with Sarah Samuels, and you're listening to the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and today we're talking specifically to our DIY investors out there listening to the show. Now, a big subsect of the population here, they love to DIY, especially when it comes to managing their own money. Do it yourself. Exactly. Do it yourself investor. So, Dave, we talked a little bit about when it might be a good time or when you really don't have any other option than to do it yourself, right? When you're younger, maybe you don't have a lot of assets yet. yet where you can pay someone to manage your money for you. And the best way to make sure that you're doing it yourself and you're doing it yourself well, of course, is to diversify. But Dave, there's times when it might not be the right time, right? It might be not a good time to be a do-it-yourself investor. You might need to transition and hire someone to help you.
Yeah, the most sensitive time is those times in the red zone. We always talk about the accumulation years when you're working, the income years when you're retired, but also we talk about that 10 years leading up to retirement, those transition years. That's the red zone. And that's when a lot of things can go wrong. In fact, the 10 years leading up to retirement and the first 10 years of retirement are the most dangerous periods where if you make a bad mistake, you might never recover. But I will say that in spite of that, I do have some people I've come across in my career, of course, that are in that zone or even now retired who are doing it themselves. And I didn't really have a problem with it because there are a couple reasons. Number one, they were sharp enough they can figure it out, right? We always talk about how to be an income specialist, you almost have to be like a credit analyst. In fact, I think we talked about that just on last week's show.
Right, last week, yeah.
Where it's like a credit analyst at the bank. Okay, do I want to give Sarah Samuels a mortgage? Let me look at her finances and see if she's creditworthy, right? Yeah. That's what you're doing sometimes when you're investing for income. So there's some people who are engineers throughout their lives that are smart enough that can kind of pull this off. But I think the key is they really have to enjoy it.
Yep. Yeah.
Because it will take a few hours a day. It should take a few hours a day in front of the computer. I would say at least 3. Now, some people who still have some money in growth will spend 5 or 6, So you've got to like doing it. It's got to be your hobby. And if you get up and you go for a power walk and then you come home and you're on the computer for a few hours, you have lunch and get on the computer a little bit more, and then mid-afternoon you're out to happy hour, okay, maybe that works. But you have to love it, and you have to have a propensity to be able to do it. And it's more of a left brain function, right? Picking stocks is a little left brain, a little mathematical, but a little right brain, a little more creative and gut instinct, what companies have a chance of doing well. When you're talking about income, oftentimes it's almost exclusively, if not a lot more left brain, a lot more mathematical. And that's why I talk about like the engineers who love doing it and are sharp enough to learn how to become, kind of sort of a so-called credit analyst.
Yeah. And that's why income's different. It's a different animal than what most financial advisors do. It's almost a specialty, like you say, with doctors. There's a general practitioner and then someone, a cardiologist or someone that specializes in a particular disease.
Sure is.
Our next Ask Dave question, though, this person might be a candidate for the DIY investor in a later phase of life. This question comes
Let me
from,
be the judge of that, Sarah.
All right, we'll see what Dave says. We'll let him be the judge. But this question is from James in Tennessee. He says, I don't love managing my own money, but I've done a good job of it so far. I plan to retire in 10 years. I'm pretty sure about this. Should I continue to do it myself in retirement? I guess he means do it myself when it comes to investing. Okay.
So I was just saying, you have to do retirement by yourself. Nobody could do that for you. So it's got to be the investing part. So James, yes, I think you really have to consider the amount of time spent doing this. And you have to realize too, and do you like doing it, and do you have the propensity to do it, right? If you are somebody who wasn't mathematical, who's maybe better at history than math, then maybe you might have done well in the accumulation years, and you might not do as well in the income years of being a credit analyst. So you've got to be somebody who's reasonably left-brained with a little bit of right-brain component. You can't be totally left-brained, which is why even a lot of engineers really aren't that good at managing their money later in life. But here's what you have to realize. The skills that got you through your accumulation years are different from the skills that get you through your income years. What do I mean? Well, think about offensive and defensive coordinator in football, right? They're different skill sets. So if you're an offensive coordinator and you all of a sudden need to find somebody, get promoted to head coach, and you need to find somebody, the first position you're probably going to fill is defensive coordinator, right? Because you could you could be the head coach, you could be the offensive coordinator. You've done that with your eyes closed your entire life. But now you're not wired to be a defensive coordinator. You're wired like an offensive guy, right? So now you've got to find that defensive person. And that's the biggest reason why a lot of people, as they get close to those transition years, really should make a change, because they're simply not wired to do both. Very few people are good at the offense and the defense. So essentially, unless you are the Deion Sanders of investing, then you probably want to consider looking for some help. And the good news about it is you're not going to be all defense. You're not going to be all income, right? It's income first, growth second. You're still going to be in charge of your money. You can hire a good income specialist. You can be the head coach. You could still be the offensive coordinator. But you're bringing that income specialist in as a good defensive coordinator. And that, I believe, is my best advice.
Yep. And James, thank you so much for sending in your Ask Dave question. If any of our listeners have a question that you would like to hear answered potentially on a future show, all you have to do is email us at askdave@retirementincomesource.com. Thank you for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are talking about the concept of managing your own money, and of course, when it might be time to bring in a new person on the team, right? You're not handing over the management of your money. We're the best stewards of our own money, but you're bringing in someone to help you. And typically, Dave, people should realize they need to make this transition that 10-year time period before retirement. But in your experience, do people even know that they should make the transition?
A lot of people don't. And I think, James was in that same boat when he said, hey, I've been doing it. I've been doing a good job. Why can't I just do it from here? Because he didn't realize that, wait a minute, the skill set that made him a good offensive coordinator might not make him a good defensive coordinator. Yeah. And that's true for a lot of folks. So again, he might be the exception. James might be the person who can do it. But the reason I said what I said at the end of James is because I believe that James is a little bit of a control freak, right? I think that he wants to keep control of it, and maybe he doesn't trust people easily, and he knows at least he cares about his money, and maybe heard some bad stories about friends that went to financial advisors, right? Yeah. I think for most people, they don't want to sit on the computer 3 to 6 hours a day. That's not what they want to do. So for the majority, that's why it makes sense to make that transition, because you hear all the stories, Sarah, right, about people who retire and within a year or 2 years they get to have some terminal illness. I mean, you have to enjoy your retirement. It's your reward for a career of hard work. Yeah. And so it's about, hey, do I really enjoy it that much that this is my favorite hobby?
I want to spend my life, the rest of my life doing this.
Not just, do I like it? This is my third favorite hobby or second. No, this is my favorite hobby. This is
my new career, essentially. It's almost a new career because of the specialized knowledge you need to really manage your money using the income methods.
That's right. And so am I dedicated to it from that perspective? Is my spouse dedicated to it, right? Or is she going to want to kill me because we retired and I'm sitting home in front of the computer screen? And then the next thing is, of course, do I have the skill set? Yeah. And that's where I think a lot of people miss. And, you hear, Sarah, it's funny, but you hear a lot of times women tend to underestimate their ability to manage their own money. Men tend to overestimate their ability to manage their own money. So it really is a male-female issue, and a lot of times it's, I would have been shocked if it were a female that called with that same question that James had.
Yeah, and for some reason that doesn't surprise me. I know historically women tend to, they go for less of the stretch jobs, they call them, thinking that they're underqualified, versus men sometimes maybe have more confidence, say, hey, I could do this. Hey, how hard could it really be, right?
Yeah, that's exactly true. Yeah. It was so nice the other day coming here. I flew on I fly myself sometimes, right? So I flew on a commercial airplane, and it was awesome. The co-pilot was a female, probably just about your age, maybe even younger.
That's pretty cool.
It was really cool. I was giving her a thumbs up, like, this is awesome. As a flight instructor, I've taught both males and females, and I find that sometimes the women are a lot easier to teach how to fly an airplane. So it's a surprise we don't have more. In fact, it's a surprise we don't have more female do-it-yourselfers in investing. But I think the reason's, again, because men tend to overestimate their abilities when it comes to investing, and women tend to underestimate.
Yeah. Maybe it goes back to the asking for directions. Women don't see any shame in that. Hey, we need help. We're okay with asking for help. Versus sometimes, men folk, they don't like to ask other people for directions. They just want to do it their own way, right?
Oh, me cavemen. Me can get you there. No worry.
Exactly.
I've got this. That's right.
Absolutely. So, all right. Well, you've been listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton, and we are going to be talking more about when is the right time, when you need to really make that transition if you're currently a DIY investor as you're entering retirement, or if you're already in retirement. You're listening to the Retirement Income Source, where it's all about the income. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and if you are a do-it-yourself investor, this show is for you. If you're someone that's currently managing your own money, or maybe you're thinking about managing your money or continuing to manage it as you enter that important phase 10 years or so before retirement. And if you're currently retired and you're doing it yourself, you're managing your own money, again, this show is for you because we're talking about all the different things that come into play when you choose to do it yourself, and it might make sense when you're younger, right, Dave, when you don't have as much money saved, when it doesn't make sense to pay a fee to a financial advisor. But there usually comes a time when people realize, hey, I don't want to do this alone. I want to add someone to my team to help me here with my managing my money.
I had a mentor years ago who used to talk about going into the doctors to get a vasectomy.
Okay.
And he had 4 children. So he said, I went in to get a vasectomy, and they're showing this brochure about the whole procedure. And he said, I got through the brochure, and it almost looked easy enough that I could do it myself. Almost.
That's a new one, a DIY vasectomy.
That's right. And he's almost. So that was this humorous way when he'd open up speaking events to talk about that. Because, yes, again, there are times when, doing it yourself makes sense. And there's times where you need help. And again, they depend mostly on people's temperament, people's knowledge level, right? You have to know your limitations. And also how much time you want to spend in retirement focusing on this versus doing other stuff. So if you're the person who plan to retire your entire life, and you've got all these trips you want to do and various things, that definitely puts you more on the side of, hey, I need somebody. And like we said to our recent call-in, it doesn't have to be where you give up control. And for a lot of men, they want to do it themselves. They want to have the control. But again, remember, like we said before, they also are a little bit overly optimistic about their own abilities, right? So you don't have to give up control to have somebody help you as you get to those transition years or into those income years. You can still be the general manager. You can still be the head coach. You can be the offensive coordinator, but you're hiring someone to be that defensive, that income coordinator.
Right. It's about adding to the team, not taking away. And Dave, in the interest of, full disclosure, full transparency, we talked about this a few minutes ago, but being your own income specialist, managing your own retirement money the right way, using the income method, it's really, you got to be willing to take on a full-time second career, essentially. The knowledge you need to know, the things you would need to understand in order to do it yourself in the right way, it would be pretty difficult for the average person without that commitment level. You
need to take a few hours most days. Not every day. You can skip a day here and there, but you need a few hours most days. And people disagree. Do you need 2, 3? Do you need 5, 6? But also depends upon how sharp you are, what tools you have. And by the way, those tools cost money. So now you're in retirement. You're not paying an advisor. You're trying to save money. But what are you doing? You're turning around and paying money for these tools. It gives you research. And still, what if you make a mistake? That's always the question. Right. And it's like kind of like you can go get a knee replacement through the orthopedic surgeon that, hey, he's done 1,000 hip replacements. He did 1 knee replacement when he was in medical school. He's licensed to do it. He knows how to do it. But is that really the person you want doing your knee replacement?
No, I want to go to the guy that's done 1,000 knee surgeries, right? Because we know he's a specialist. So let's get to our next Ask Dave question, because we have a really interesting question here from Nicole in Florida. Nicole says, Dave, I heard what you said. I'm an engineer. I know I'm a female. I'm in engineering. I know it's a little unusual, but I'm also thinking about managing my own money in retirement. I think I would do the best job. My plan is to stick with mutual funds, and I don't think that will require much work overall. What do you think?
All right, Nicole, I love it. Well, thank you for coming here. And you again.
She said Nicole said you're wrong, Dave. There's engineers out there. There's women out there that want to DIY.
That's awesome. Like I said, there are female pilots, right? Absolutely. I just had one the other day on the plane, and I love it because I think women have the propensity to make better do-it-yourself investors than men. Because men, you get ego, you get control, you get certain factors that can kind of cloud judgment. But the only problem I have, and if you're an engineer, you're probably mathematical enough. If you took some time studying before you got to retirement in those transition years about the various income generating tools, you could probably be fine. And if you like doing it, well, that's fine too. The only problem I have with what you said, though, Nicole, is you mentioned mutual funds. And mutual funds, I believe strongly, are not a good tool for most people in retirement. And here's why. Let's split up stock funds and bond funds, right? So first of all, bond funds. When people buy individual bonds, they buy them because they want a fixed interest payment for the life of the bond, and they want a fixed repayment of the face amount, the principal, at maturity. And that's why retirees love bonds. The problem is when you buy bond funds, neither of those two guarantees exist. Both guarantees are off the table. Why? Because there is no fixed interest payment. It can fluctuate and will fluctuate on a regular basis. And number two, there is no maturity date, right? Because mutual funds don't mature. So there's no maturity date at which it's guaranteed to pay back the full face amount. So when you're buying a bond fund, Nicole, you're literally buying the stock of a company that owns bonds. That is the definition of a bond fund. Stock of a company that owns bonds. Riskier because you're losing those two guarantees. What if you went to higher dividend common stocks? Okay, but good luck finding a higher dividend common stock mutual fund that's good. In fact, Nicole, I will tell you, I was so frustrated trying to find an exchange-traded fund, similar to a mutual fund, that had paid a high dividend, that kind of high dividend common stock, but still had a good, sensible stock strategy, that I got so frustrated not being able to find one, I created our own exchange-traded fund. So it's really hard on the stock side because most stock fund managers are afraid that, hey, if I deviate too much from the S&P 500 index, which is at an income yield of, 1.3 right now, if I deviate too much, there's going to be years where I underperform and I'm going to lose my job, right? So as a result, they tend to be closet indexers. They tend to follow the index. So that's the problem with mutual funds. Whether you want stock funds or bond funds, most likely it's going to be really difficult getting funds that specialize in an income-first, growth-second approach.
Yep. And Nicole, thank you so much for sending in your Ask Dave question, proving Dave wrong here. There's lots of female engineers out there that might want to do it themselves when it comes to investing. But thank you so much for sending in your email. And if any of our listeners or YouTube viewers out there have a question that you would like Dave to answer, potentially on a future show, all you have to do is email us at askdave@retirementincomesource.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are talking to those of you out there that are all about doing it yourself, those of you that have been managing your money thus far. Maybe it's going really well for you and you really don't see a reason to change, because a lot of people, Dave, I think they suffer from inertia. It's not just that maybe they're overconfident in their abilities. Maybe, I've done a good job so far. It's really that, do I really need to change? It's worked for me so far. Why should I change what's working?
That's a really big thing, Sarah. You're right. It's worked for me so far. Why all of a sudden is the same strategy I was using in the accumulation years bad for me in the income years? And, the answer is simple. It's because in your accumulation years, you want a total return. You didn't care if it came from the I or the G, the income or the growth. You just want a total return. You looked at your statement once a month, once a quarter. If it went up, you felt happy. If it went down, you felt sad, right? We call it the 401k brain. But when you retire, it's not about net worth anymore. It's about income. It's about the amount of interest and dividends that portfolio can generate. And what that means, of course, is that, if you don't do that, you're taking principal. And some people try to do that. They try to use the withdrawal strategy. Well, I've got $1 million. I'm going to take out 30 or 40,000 a year, withdraw it, and hope it grows back the next year. Well, you can do that, but that always increases the chance that you'll run out of money at some point. So that's why it's so important to make that transition as you're getting that close.
Right. That's a huge gamble, of course. You talk about it all the time, Dave. If we look at that 13-year period between 2000 to 2012, if you had invested $1 million starting 2000, by the end of that, you would have had $500,000 left in your account. That whole growth thing wouldn't have worked out in that time period. And since no one has a crystal ball and you're not sure what the markets will look like after you retire, relying on the income method is definitely a better strategy than with withdrawal.
Well, and there's more. There's more too. I mean, think about, if you were working and you had a financial advisor, maybe most of your money's in a 401k, but some of it was in IRAs or non-IRA money, and you hired a financial advisor, and then you took a big hit in 2008. Maybe you dropped 56% with the market. Maybe you dropped a little more if you're aggressive. Maybe you dropped slightly less, but still was too much for you, right? And now you get a bad taste in your mouth about financial advisors, right?
You feel like, they just want to take risks with my money. They don't care like I do.
That's right. That's right. But it's kind of like saying, hey, my mom died of cancer and the doctor couldn't save her. So I got diagnosed with cancer. I'm not even going to try to treat it because doctors don't know what they're doing, right? Not all doctors are created equal. Not all financial advisors are created equal. And so a lot of people, they want to control it because they don't trust it. They've had a bad experience. And that's really, truly unfortunate. So if we had any success with you today in terms of getting you to realize that at some point you might want to have someone help you with your investments as you approach retirement, and you could still be the primary coach and the offensive coordinator, but you need that defensive income coordinator, then stay tuned as we, coming up, talk about how to find that perfect specialist in retirement. I'm David Scranton here with Sarah Samuels, and you're listening to the Retirement Income Source, where it's all about the income. Welcome back to the Retirement Income Source, where it's all about the income. I'm David Scranton here with Sarah Samuels, and today we are talking about those of you who are do-it-yourself investors, whether you're doing it yourself because you're good at it and you really enjoy doing it, or whether you're doing it because maybe you had a bad experience, or maybe the strategy you've used so far just worked for you and you don't see a reason to change. So far, we've discussed situations where it makes sense to be a do-it-yourselfer for many people. We also discussed situations where it often doesn't make sense, but even exceptions to that rule, where if you're close to retirement or you're retired, you love doing this is going to be a retirement hobby, then hey, that's great, especially if you have the knowledge to be really a good credit analyst. And Sarah, of course, we ended up talking about why mutual funds are not really the best answer either in the world, in the income first, growth second world.
Yeah, it was kind of funny. I feel like Nicole, it was a question from Nicole, or Ask Dave question. I think she maybe is a newer listener, because if she was someone that's been listening to us for a while, she would know that you do not recommend mutual funds or bond funds for anyone that's in retirement or transitioning to that retirement phase. Yeah,
that's right.
It's usually not a good idea, right? Because there's none of those guarantees that you get with the bonds, or even some of those bond-like instruments, as we call them.
Yeah, that's right. Absolutely correct. And so I guess the question now is, okay, what if we, I think a lot of people probably sat up and paid attention when I said something like, okay, you don't have to give up control, because a lot of people do it because they want to keep control. They've heard horror stories about giving up control, right? They heard about Bernie Madoff.
Losing everything, right?
Right, Bernie Madoff, they send their money over to him. Next thing you know, he's going to jail and their money doesn't exist, right?
They have no recourse, absolutely.
That's right. So the first thing to realize, I think, for all your listeners out there, is that we're not talking about putting your money in hedge funds. Bernie Madoff got away with what he did because he was a hedge fund. He created his own investment statements. He had all the investments for all of his so-called customers, clients, in one pool. He managed it as a pool, and the statements he created were separate on his own, which allows someone to commit complete fraud if they're dishonest, like Bernie Madoff was, right? If you're working with a fiduciary, registered investment advisor, who they can't do that. They've got statements most time from big clearinghouses. You could be with Fidelity, you could be with Schwab, massive clearinghouses that hold your money. So first of all, if you're concerned about trust, the whole concept about theft goes out the window, right? With our clients, Sarah, we cannot take a withdrawal. We cannot touch our clients' money. So now you're just worried about poor management. Is somebody not managing it correctly? And that's where now you have to keep a bit of a closer eye. But like I said, my hope is that some of you who are doing it for control purposes, or maybe had a bad experience before, are now realizing, wait a minute, I can go ahead and shop for somebody. I can look for somebody. Why? Because I can be that head coach. I don't have to give up total control. I can even still be the offensive coordinator if I want to continue my growth strategies for that part of the portfolio. But I need that defensive coordinator. I'm not wired that way. I need to hire that person who is that credit analyst so that they can do 90% of the heavy lifting, and I can just make the big decisions.
Yep. Well, our next question comes from a listener who seems to be in that boat, Dave. This is someone that he's very interested in working with someone, but he needs some help. So we have a question from Alan in New Jersey. He says, I really want to work with an income specialist to help manage my money when I retire about a year from now. I've been to a few workshops and seminars for retirement advisors in my area, but how do I know that I'm working with a true income specialist?
Okay, it's Alan, correct?
Alan from New Jersey, yep.
All right, Alan from New Jersey. So, okay, so I'm glad to hear that you're open to that. That's great news. How do you know, after going to workshops, if you're with a true income specialist? Well, first of all, and you may not know from the workshop, you may have to take them up on that individual meeting and use it as an opportunity to interview them as to what they're doing, what their specialty is and isn't. But at the workshop, you can see, first of all, what they recommend. If they recommend products, if they talk a lot about the stock market and stock picking, well, they're probably a G first, I second person, so not an income first, growth second, so that probably doesn't work. If they talk a lot about annuities at the workshop, then they're probably just focusing on a subsector, and a lot of people who do these workshops do that. You're focusing on a subsector, which is an annuity, as opposed to focusing on the universe of income-generating options. Because, Alan, there's about 10 different income-generating options. Annuities are really just one. So, again, I'd be careful. Because, to me, you need to look for somebody who is an income-first, growth-second person, so they can have some growth in your portfolio as an inflation hedge. That's important, right? Even as you get older, you want some growth. But income first, right? And specializing in the universe of income generating options. So if you take them up on the offer for that complimentary meeting, and the offer is always there, there's several things I think you should do. So first of all, talk to them about their typical client. And if you confirm their typical client is, your age or slightly older, then go ahead and don't be afraid to ask, okay, well, what allocation between stocks and bonds does that typical client have? How many of those clients typically own annuities? What percentage? You might ask, are you using individual securities or mutual funds? Like if you're here for our last Ask Dave question, you heard that mutual funds are not a great tool in retirement, right? But if somebody says, hey, we're fiduciaries, we work with all these different income specialists, annuities are part of it, but not all of it. Some of our clients have a reasonable portion annuities, others have none. And then they say they do individual securities. Now you're at least starting off properly. But then you have to go and find out, where they get the research and how they do their work. So stick around for the rest of the show, though, Alan, because I want to talk more about, again, how to interview that advisor when you come in for that one-on-one complimentary meeting.
Yep. And Alan, thank you so much for sending in your question. If any of our listeners have a question, maybe you're wondering yourself, how do I find the right income specialist? All you have to do is send us an email to askdave@retirementincomesource.com, and you may hear your question answered on a future show. And thank you for listening to the Retirement Income Source, where it is all about the income. I'm Sarah Samuels here with Dave Scranton, and today's show has been really geared towards those do-it-yourself investors, no matter what age you are. As a lot of people, they start off doing it themselves when they're younger, right? Because they don't have a lot of assets. But there comes a time in life when most people, especially as you near retirement, you really need to consider this transition and consider working specifically with an income specialist, someone who specializes in generating income from your investments.
In the income stage and in the transition stage.
In both stages, right? That 10-year stage, that all-important red zone stage before you actually retire. So, Dave, let's talk a little bit about why income specialists are different and some of the research that goes into picking the right investments for income.
So it's important, of course, because you want to have an income first, growth second approach. Because like we said before, if you're trying to withdraw money in your accounts from your accounts in retirement and hope that it grows back, well, you don't need me to say that hope is not a strategy, right? That doesn't work. So you have to have an income first, growth second approach. And that's different from most advisors. So a lot of advisors work for bigger firms, Sarah, where they can't be snobs like we can. We get somebody who's your age, and we're going to turn them away.
Right. You're going to say you're not right for me.
That's right. You go to somebody, and we might even refer you somewhere. But most people work for big firms, and they can't do that, right? Their manager, the boss would get pretty ticked off at them. So they've got to take everyone. So as a result, they become a total return-focused advisor and don't pay attention to where it comes, whether it's from income or growth, just total return. So that's one of the problems with a lot of advisors. The other thing is a lot of independent advisors who are fiduciaries charge fees. And they want to put you in more aggressive stuff because over the long run, even though there's going to be dips, it should grow faster, right? Not caring that if you're retired, you don't care as much about growth, but it should grow faster. And if it grows faster, because their fee is a percentage of your assets, their fee goes up.
Right.
So for some reason, some ways it's a better business plan for the advisor.
Yeah.
And lastly, a lot of them don't want to do the research. I talk to advisors all the time when I talk to them about specializing in income. I said, why don't you? And they know they should, but they say it's too hard. I don't want to do the research. Because what you have to spend on technology in your firm in order to be able to get the research is much more extensive than what you have to spend for typical stock analysis, right?
It's a lot easier to do it that way, right? To invest for growth in the stock market versus income specifically.
And because of the level of research, you probably need to have a specialist you need to hire at a pretty steep salary to come in and do that. You could buy stocks using a lot of outside reports and, sit home at night in front of the TV and look at the reports and decide what you want to do for your clients. But with income first strategies, it takes a lot more than that. Yeah. So in most cases, you just can't do that. So you've either got to spend a lot of money or take a lot of time. And most advisors they're like our listeners, Sarah. They want balance in their lives. They don't want to retire and be investment managers. And even investment managers know that they've got to spend time with clients and have some family time. And and they don't want to make the commitment.
Yep. Well, a lot of advisors take a generalist approach, whereas our income specialists are really specialists. They have the right equipment, you mentioned the right software, the right specialized training to be able to help people really generate income the right way. So if you're looking for someone to help you, if you're looking for an income specialist, again, you can always check out our map. You can find an income specialist right on retirementincomesource.com, so you can check it out. That's one surefire way to know you're working with an income specialist.
Of course, the other way to learn more is to make sure that you're here with us next week, same time, same station. I'm David Scranton here at Sarah Samuels, and you're listening to the Retirement Income Source, where it's all about the income.